Hello and welcome back to this channel. In today's video, we will take a look at how the financial markets performed in the third quarter and discuss the broader developments we've seen so far in 2025. Joining me once again are Mario and Andy Sheng. So before we dive into the questions for you, Mario, let's start with a brief summary of what happened over the past 3 months. Instead of the typical summer slowdown or high volatility, the past 3 months brought us stable markets and continued price gains. A rare picture for the third quarter. This is likely due to the fact that global central banks are still cutting interest rates or at least considering further rate cuts. That's always a favorable environment for financial investments. However, there are also some clear losers. Indian equities and the healthcare sector have been lagging behind. The same applies to long-term European and US government bonds. Meanwhile, corporate bonds and gold are in high demand, more than they have been in a long time. At the same time, many international investors are repositioning and reallocating capital away from the US into other markets. Europe, Asia, and even long-neglected emerging markets are coming back into focus. There has also been movement within factor strategies. Value and momentum are making a comeback, while the popular quality factor has been underperforming this year. And finally, investors are increasingly turning to smaller companies, at least outside the US. So Mario, can we summarize that you are kind of satisfied with the year's development so far?
Yeah, I think so. I think we have to be quite grateful and happy. I mean, the performance of this year in pretty much all asset classes is higher than usual. We speak of long-term returns in the global equity markets in the range of 7 to 10%, and many equity markets have far exceeded that. Of course, we should argue that maybe non-US dollars investors, let's say European investors, sterling investors, or Swiss investors, don't look at these numbers so favorably because the US dollar has lost quite a bit against these currencies. But most of our investors are US dollar based or based in currencies that are quite highly correlated to the US dollar. So they're very pleased with this market, especially if they dared to invest overseas, meaning outside the US. Okay, we could argue that small and mid caps in the US haven't done so well. That's a bit of a surprise to me because I looked at them as a Trump trade because Trump is promoting the US industry and is looking to help small and medium sized companies. But it appears that they're still suffering a little bit from the slightly higher interest rates. And we've seen them move lately, but not to the degree that other market segments have moved. And I guess we need to see further Fed cuts to see that market segment move in a major way. Looking at especially at the S&P 400 or the S&P 600. But yeah, we're quite happy, and despite the, let's say, the difficulties in April, or let's say especially if we look at the difficulties in April, very few investors would have thought that by now, just a few months after, we'd be making new highs in many markets.
So I already mentioned at the beginning that emerging markets are becoming more important again. Do you agree that this applies to all emerging markets, or do you think that we have to take a differentiated view on specific regions or specific countries that are emerging markets?
Fundamentally, or let's say typically, we would say that emerging markets as a group are beneficiaries of a weaker US dollar. So fundamentally, all these markets should be doing better. And in fact, they are doing better. If we're looking at Asia, if we're looking at Latin America, the performance has been remarkable. Also, China, which is a market that's been down and has really disappointed many of us for several years, is doing quite well this year. Only India is lagging a bit, but I think that can be justified by the fact that it's been quite expensive, and I think long-term investors in India are sitting on nice profits, and a market can't go up every year. There's time for a market to adjust a little bit, and I guess that's what we're seeing in India. But I would say yes, the segment as a whole is benefiting from a weaker US dollar. And maybe what we should also highlight, our colleague Michael has been emphasizing that Vietnam is looking particularly good. There's a chance that the Vietnamese market may be um, re well recategorized, I guess that's the right word, into emerging market. Currently, it's considered a frontier market, but it could be recategorized as an emerging market by some of the index providers, by FTSE Russell and potentially MSCI. And this would naturally mean that more money will flow into Vietnamese equities. But I think, regardless of this recategorization or readjustment, I think Vietnam is interesting. And we've been investing in Vietnam, and we're actually quite happy with that, and can foresee this to be a good market in the coming years. Maybe also Latin America. I think many Asian investors are traditionally not looking at Latin America, but if we look at Mexico, if we look at Brazil, these are countries that are important to both America and China, and I think that that gives them a certain amount of leverage. And valuations are pretty low, and especially for our Asian audience, it's probably interesting to see that in the long term, in US dollar calculated, the Latin American markets have actually outperformed Asia. And as valuations are currently low, it may be a good idea to add a little bit to Latin American equities. And we would do this either via an active manager from Deutsche Asset Management, or via an index, provided this manager isn't available. But I do foresee Latin America as a big beneficiary of the current environment and also a weaker US dollar.
So, what is your perspective on gold? Because right now, if we look at the gold price, it's very high. Do you think this is still justified, or is it maybe too high right now?
Well, people who know me know that I'm actually not a gold buck. Um, I guess I'm a scholar of Warren Buffett, and Warren Buffett is also known to be quite skeptical about gold. But we cannot deny that gold has moved dramatically in the last 3 years, and it's doing well. So we cannot ignore that. And I think there's a space for gold in an investment portfolio at this point in time, because the world has really shifted. We're looking at what's happening in China, what's happening in America. We're looking at how the US dollar is about to lose its credibility, which is quite concerning, and naturally forces us as investors to diversify. And a lot of people have concluded that gold is now their currency of choice, if you want to call it this way. But in the long term, gold is was always meant to maintain purchasing power. So if you there were people who would say, okay, you could buy a nice suit in the 1930s for an ounce of gold. Now if we're now looking at an ounce of gold today, it reached $4,000. Is a nice suit really $4,000? I'm not sure. I've also done a, let's say, small analysis over the weekend to compare the Big Mac measured in gold in the 1950s all the way to now. And nowadays, you get a lot more Big Mac than you would get in the 1950s for gold. And the same with other goods and services. So it looks as if there's a bit of a mania going on. The Financial Times quoted it as fear of missing out yesterday in the headline. I do think, whilst gold fits in the current environment, and there's a chance that gold may rise further in the coming years, whenever I see a chart that looks like an antenna, I'm getting a bit nervous. And a lot of people have been asking me about gold. A lot of friends and family that don't really care about investing normally have been asking about gold. And normally, this is a sign that a lot of people who are jumping on the bandwagon have already been doing this. So let's not forget, it's not an income generating asset. It really is an asset that requires a lot of faith. So I would say everybody who kind of missed out on this train should allow him or herself to not jump on it now. There will be adjustments. There's a good chance that it will not go in a one-way street, as nothing goes in a one-way street. So anybody who's interested in dabbling a little bit with gold, I would recommend to hold your horses and wait a little bit. Obviously, people who have a lot of gold, I wouldn't also necessarily tell them to sell it. But it smells frothy. It smells like fear of missing out here, and that's not normally an environment to be successful when investing in the long term.
Okay, so last but not least, we replaced several actively managed funds this quarter. And the question is, what criteria do you use to determine when an actively manager kind of has lost our confidence?
Yeah, in general, I guess people know we're quite comfortable with index investing, and our advisory universe is comprised of about 70% index solutions or factor index solutions, and only about 30% is active managers. And we choose these active managers typically in market segments where there is no efficient index available, or we do it when these are really outstanding teams or individuals who know how to manage money better than an index. They do exist. A lot of people and a lot of academic word will tell you otherwise, but such managers exist, and our clients have the benefit of accessing these managers at very low cost or very cheap pricing, institutional pricing, no upfront charges. So these active managers don't cost much more for our clients than index ETFs. And that's why they compare favorably compare to certain indices. Let's say, for example, our one of our favorite bond managers has been outperforming the Bloomberg Barclays Global Aggregate Index by at least 3 points every year in the last decade. And why should investors ignore such performance? But coming specifically to your question, when do we select a manager and when do we exit a manager? Typically, these managers have to have a clear profile. So we need to know where the outperformance is coming from and why they do such a great job. And we would then naturally look at this for very long periods. We typically want to see at least 10 years of outperformance. If it's just 3 years, that doesn't really impress us. And that would by default qualify them, and we start investigating a bit further. At the same time, if a manager, for example, changes his style, there's something called a style drift. So let's say if a manager told us he's a quality manager, he buys companies at very high profitability, very low indebtedness, and the likes, and all of a sudden buys cyclical stocks or buys stocks that don't meet this criteria, the red flags will go on, and we will typically then put this manager on hold or even exit this manager. This is something we don't want to see because let's say Warren Buffett is known for quality and value. If all of a sudden he were to launch a fund that invests in artificial intelligence, I think we'd be very skeptical and we'd probably not buy into that. And this also happens with managers. And yeah, now unfortunately we have the situation that two of our preferred managers, that is Walter Scott from Scotland and Terry Smith from England, or he actually lives in Mauritius, but he's a very popular English manager. They have shown underperformance for 3 years now, and normally we're quite patient, and the fact that we've been waiting effectively 3 years for these managers to recover shows how committed we are once we've decided that the manager is our manager. But we feel that Terry Smith has become quite stubborn in that he's been running a very concentrated portfolio, and he made a big bet on Novo Nordisk, which is not by itself a big problem, but he put 10% of investors' money into the fund, and it turned out to be a bad idea. And this happened with few of his stocks, and I guess we have seen that his portfolio was probably too concentrated, and I just don't like seeing things like that. And the problem is also once investors are losing faith in a fund and are redeeming the units, basically what we're doing now, it'll be more difficult for this manager to continue his strategy. He will have to sell shares to meet redemptions and so on and so forth. So that's also one reason why I want to exit it, because I know a lot of English investors are exiting the fund, and we don't want to be the last people exiting him. And Walter Scott in Scotland has been heavily investing in healthcare, um, which is not wrong because we like the healthcare sector. We deem it quite cheap and attractive, but we don't look at Walter Scott as a healthcare investor. If we want to invest specifically in the healthcare sector, we might as well buy a healthcare manager because we have good solutions in the healthcare space in our platform. So we're saying goodbye to these managers with a heavy heart. I'm a big fan of the two managers of the teams, and I think they will continue to do a decent job. But in contrast to banks, we're very competitive. We're really looking at the best possible in building blocks for our clients, and so we need to say goodbye for the benefit of our clients. That's what's happening.
The S&P 500 and Nasdaq have been making new highs every day against a backdrop of what many people have been saying are overvaluations. Do you believe that both these markets are a bad time to be entered at the moment, or would you think there's still room to maneuver?
I mean, we're using this valuation traffic light in our reflections document, and I would encourage everybody to take a look at that. And the current projected um, basically the projected earnings yield for the S&P is now in the range of about 4.2% for the coming decade, and that is far below the typical 6 to 8% that we're expecting. And for the Nasdaq, it's about 3%. So if we're just looking at these simple valuation metrics, the markets are expensive, and there's a very high correlation between the current valuation of an index and the 10-year forward forward return. We've seen that in the late 1990s when you bought the Nasdaq 100 and as well as the S&P 500. You didn't earn much money, or actually you didn't earn any money in the following decade. And this could happen again now. Um, and I think sometimes investors are really hung up with certain ideas. Now everybody is really infatuated with the Magnificent Seven, specifically Nvidia and so on. But had people allowed themselves to look elsewhere, for example, European banks, I mean, the much hated European banks have performed much better than the Nasdaq 100. That's hard to believe, but it's true. Also in Asia, we've seen a lot of very positive developments. So I'm wondering if somebody who has choices internationally should still chase this dream that is now a bit long in the tooth. So at the same time, I think one reason why these markets are still holding up so well is the fact that people are wondering what to do with U.S. Treasuries. U.S. Treasuries, I mean, it's quite clear that the current government is looking at a weak dollar. It's also quite clear that they could see themselves looking at some form of restructuring of U.S. government debt, which would be catastrophic, by the way. So I don't think this will also happen in the next couple of years. But some of them are talking about taxes for overseas investors, taxes on interest, and so on. So I think people are just wondering how they can maintain an allocation to America but de-risk. And let's say if you have concerns, or if anybody has concerns about U.S. Treasuries, that person but still wants to be in the U.S., because let's not forget, China is not a liberal market, and the long-term performance of Chinese equities has been very poor. European regulation is heavy. The same goes for Japan and countries like Korea. So it's not easy to find a financial market as liberal as the US. But if you feel you don't want to earn long-dated US Treasuries, but you want to have allocation to the US, you may actually conclude that maybe an allocation to the S&P 500 or even the Nasdaq 100 can help you there, even if the projected returns are quite low. I wouldn't chase it. We've been encouraging our clients who are heavy in Nasdaq, heavy in S&P, to diversify either in small mid cap or the equally weighted S&P 500. Actually, one interesting news, we talked about active management earlier. One of our preferred tech managers, that is Threadneedle Technology, this manager has actually outperformed the Nasdaq 100 and has basically beaten the Nasdaq 100 by a wide margin this year. And the reason for that is the portfolio is much more diversified. He buys about 50 stocks, and hard to believe he's really been beating the Nasdaq 100 for in the last 15 years. The guy has been around since the mid to late 90s, so he really knows what he does, Mr. Wick, Ben Wick. But yeah, I'd suggest caution. Um, if you have a lot of it, maybe you shave off a bit, and if you don't own it, don't chase it. There are better options out there.
Speaking of long-term treasuries, it seems that the fanfare around the Federal Reserve meetings have died down a lot. It seems inflation has more or less kept to a path, and the Federal Reserve has also stuck to a certain path. Do you think this is the end of inflation and interest rate surprises, or do you think there's more to the story to come?
Um, yeah, we will see. I think certain goods have become more expensive, like furniture and so on and so forth. And US core inflation hasn't come down further, so it's still right around 3%. I think we need to wait for the coming quarters. I mean, US unemployment seems to be going up, which is typically disinflation in nature. Uh, the price of goods seems to be going up selectively. So I think the next couple of quarters will show what the tariff really means for the US consumer. And I mean, at the moment, it looks like it can be contained around 3%, and that means the Fed does have room to cut rates further. But obviously, we don't want to see a surprise, right? We don't want to see inflation creeping towards 4% because that would be difficult for the Fed to cut rates, even if Trump elects a very dovish Fed chairman. They may not have the leeway to cut, but it is, I think, if things stay as it is, it can be rightly assumed that the Fed will cut maybe towards 3% next year, which will be good, which will be good for small mid caps. It will be good for financial markets in general, but it may be bad for the US dollar. So I think people who, yeah, let's say people in Asia who spend Singapore dollars, um, they may need to be a bit careful with their US dollar exposure. In Europe, the same, but US assets should fundamentally go up. I mean, not only US, I think global assets should fundamentally do well in times of falling interest rates.
There have been a lot of questions around evergreen private equity funds recently. For a brief introduction, evergreen private equity funds allow for periodic subscription and redemptions compared to the traditional private equity funds, which are typically locked up for 10 to 15 years. Do you think that the traditional premium that private equity used to derive from this long lockup period is being diluted away by these new evergreen funds? Or do you think these evergreen funds sort of fit the hybrid of higher returns, lower volatility, yet still have the liquidity premium, or is it too be, could to be true?
Yeah, uh, I guess our audience knows by now that we're not particularly greedy in terms of private assets. That we think liquid assets are easier to manage, and that we're skeptical in certain ways. That said, we have um, analyzed the many offerings of evergreen funds, and we found a few that we do like, and we've recommended it to clients. I think the benefit of an evergreen fund is that you can indeed sell it ahead of the usual lockup periods. But what we do is whatever evergreen fund we would recommend, we classify them as red in our fair horizon concept. That means they should be held for 15 years plus. So we clearly put them in the portfolio as a long-term allocation and not as something that should be sold early. That said, like we spoke about managers earlier that we're disappointed with. So let's say if we were to become disappointed with one of the evergreen managers that we had recommended, at least we could sell it after a year without paying a penalty. So I think there's some critical, there are actually a lot of critical voices out there, And I think where it's getting really dicey is when these products are shown to retail investors for very small limits. There's now a bank in Germany that's doing this. I find this difficult because it's not an asset class that is meant for everybody. Um, and it's also okay that it's not there for everybody. I think if people have limited funds available for their investments, there are a lot of good choices. And I personally think that a lot of these private equity offerings are shown to private clients specifically because they're a great source of revenues for the banks and for the product providers. Typically, they have higher fees than ordinary funds and much higher fees than ETFs. So they have to pay at least 2%. And the banks that distribute these typically earn 2% annually. So naturally, if you earn 2% on something and the client doesn't do anything, that's perfect for you. And we've looked at data from market providers and let's say private equity returns before feeder vehicles could be calculated in the range of maybe 15% on a broad base. So if your feeder costs 3%, you're already down to a target return of 12%, and that's already very close to public markets. So I think it's important to discern between the different offers. So some of the offerings are interesting, and we've been showing them to clients, especially the ones that are typically only focusing on leverage buyout and growth equity. I'm personally quite skeptical on private credit, but some of our clients have been asking for it. Um, I think transparency is important, and many of these offerings are not transparent enough, and they're also too expensive. But well, we're looking to provide transparency to our clients, and whenever we recommend something, it would typically be the lowest cost share class. So the few investments that we've taken have been costing anywhere between 0.8 to 1% management fee. So that's much below the market. But it also shows that it's possible to access quality managers at a good price. And it's our ambition to make that available to our clients. But just because something is new and it smells good doesn't mean we would recommend it. And we'd be very, how would I say, we're quite skeptical, especially if these products are offered to retail investors.
Okay, so one last question before the end of this video. What are your expectations for the final months of the year?
Well, as always, I'm not clairvoyant, so I have no idea. But typically, the fourth quarter is a good quarter. That said, the third quarter is typically a bad quarter, and this year it's been a good quarter. So if seasonality is different this year, um, maybe the fourth quarter will be a bit different. Yesterday, Paul Tudor Jones came out on CNBC and he said that he's expecting a market blow off similar to what happened in 1999. That means we will see another big leg up because there's a lot of fear of missing out. And but we know what happened in the year 2000. So after this big market move, we saw a market implosion. I mean, I don't foresee a market implosion, but I also see markets that are not cheap across the board. And if markets are not cheap, that means there's always room for adjustment. So I would say seasonality is positive, and I think a lot of people who've been in the market want to stay in the market to earn their fees at the end of the year. Um, but it it may just be a Q4 lull, so that means not much is happening. A little bit up, a little bit down, and we're closing maybe a little bit higher from where we are. But that's just a statement, right? So what is important to construct good portfolios, you have to look at current valuations. And I think what we can say here, if you look at markets outside the US, valuations are not cheap, but okay, especially after this September. Asia has also become more expensive. It was much cheaper at the beginning of the year. So many of the markets that looked really, really cheap are not cheap anymore, but look more fairly priced. The same goes for US small mid caps. Private equity, actually, leveraged buyout doesn't look expensive, especially because most of these companies are small and medium-sized companies. So we could foresee putting a little bit of leveraged buyout money to work. Um, some of our clients also made commitments to a very attractive venture capital fund of fund offering, which I think is quite unique and worth our while. But I'd be surprised if the market were to make a very big move in the coming months. I mean, Paul Tudor Jones is obviously much more successful than me, but he made a call in May that the markets would be very weak and would go down. They didn't go down in the following months. So if now he says the market is going to shoot up, maybe he's wrong again. But I think it's important not to worry too much about these things. Look at your individual cash flows, look at valuations. And in that regard, if somebody has to put fresh money to work today in stocks and bonds, he finds an environment that is worth entertaining as long as you stay clear of the very expensive US market segments. It should be okay. It always pays to be optimistic and don't listen to all these fear mongers.
Okay, so we have reached the end of today's video. You can download the quarterly report via the link in the video description. You can also find there our contact details, so if you have any questions about your current or future investments, you can always contact us. We are happy to help.
Absolutely. Let's stay in touch, and we're always here for you. Enjoy the rest of the year.
Bye.
Bye bye.